Hello and welcome to Euranet Plus. Today, in our monthly program with the European Policy Center, we focus on the decision that the European Central Bank undertook last week to buy 16 billion euros in government bonds per month during at least 1 year and a half. So to discuss the impact on the EU economy, I'm with the director of the European Policy Center, Fabian Zuleeg.
Hello.
Hello and welcome. So, starting from March until the end of September 2016, the European Central Bank will buy a total of 1.1 trillion billion euros. So this amount will be concretely have an impact on the EU economy? Concretely, what will be?
Well, certainly it will have an impact. It's difficult to be precise about what the impact is going to be, but we've already seen that markets have rallied in the eurozone. Stock markets have gone up because there's an expectation that there will be more credit given, and that means more economic activity, which should mean more growth.
So the European markets and also the Asian markets, will that be to the global markets as well, the US markets, for example?
Yes, I mean, the Eurozone is an important component of the global economy. We've had depressed demand in the Eurozone for a number of years now with the crisis. So anything which looks like it's going to boost consumption, demand, imports within the Eurozone will also have an impact on the rest of the world.
So this amount will be enough to tackle deflation?
Well, I think firstly, it looks like it is a significant amount. We've been expecting this move for a while, but now it is on the table. So clearly, markets are expecting it will have an impact. My view is it's an important component of an overall strategy, but it cannot be the only step. There needs to be more on the table to tackle the underlying structural problems in the European economy, which predominantly means low growth and not just low inflation.
So, for example, Mario Draghi, the chair of the European Central Bank, say that it's also the responsibility of the governments to take some measure and to invest more. So is this plan of the ECB a part of the 315 billion euros investment plan from Mr. Juncker, the president of the European Commission?
Well, it should be seen in conjunction with Juncker's investment plan, but Juncker's investment plan predominantly tries to activate private investment. What is still missing at the Eurozone level is public investment. So where are the public investments from countries like Germany, which still have fiscal space to be able to make some more public investments, which also have very, very favorable financing conditions. Interest rates are at record lows. So we also need some movement from national governments to invest more public money. So far, that is not happening.
So we can see this ECB purchase plan as a push to member states to invest more. Is this like a kind of push? Okay, go and go now with your reforms and invest more and more?
Well, it certainly has been emphasized by Mario Draghi that it's very dangerous to just rely on quantitative easing, that we do need this investment, but at the moment, member states are very reluctant to take that step.
And so another important point that the European Central Bank announced is the risk sharing. So the ECB announced that the risk of any losses will stay mainly with the European national banks. So they will ensure 80% of the bonds bought, and the ECB will just take the other 20%. What does that mean?
I think in the short run, it will make very little difference. For the markets, what they see is that significant amounts of euros are going to be pumped into the system, whether that is through the national banks or through the European Central Bank directly, won't affect the market so much. In the longer term, the big question is whether there's a political risk. What would happen if one part of the Eurozone would split up? If you had, for example, a Brexit, then you could have a significant risk for those who are covered by that particular central bank. I think the chance of that are quite remote, but it means we still have to be aware that politics still will have a big impact on the euro crisis.
But now with the Greek elections result, the Grexit is far I mean, it's not that possible. It's gonna really come really into reality or not?
Well, I
mean,
think it's very unlikely that we will see a Grexit, despite the fact that we have a different government, likely to have a different government in Greece. What we are going to see is some renegotiation about the terms of support. But hopefully this will actually be something which has a positive impact across the eurozone, given that we need a different approach to austerity. But in the end, we shouldn't forget that structural reforms within the countries which are in crisis remains important. And I think that is one of the dangers of the quantitative easing we're seeing now, that it might also remove some of the incentives for these governments to carry out reforms.
Thank you, Mr. Zuleeg, for coming. And thank you, all of you, for following us. Bye.